I think there's a tremendous opportunity in multifamily housing. With respect to condos, we are hearing that there's a little bit of a slowdown in absorption of condos given the high interest rates. But at the end of the day, there's still tremendous demand, and a lot of inventory was taken offline with in the last 12 months, given the strength of the housing market.
Let's get to tonight's show. Tonight's show, the future of the real estate industry. We're now here in mid-2022. We're going to try to forecast. Now, of course, as always, contact your local professional advisor for any specific advice that you're about to embark. But I'm joined here, co-hosted by a good friend, Shia Rubenstein, who has his upcoming JCon conferences, and invited along Shimon Eisikowicz from Cross River and Morris Betesh from Meridian Capital. Shia, thank you for joining me here. And to the great guests, take it away.
Good evening, Yitzchok. Wow, what an introduction.
Thank you. The guys deserve it.
Wow, that's fantastic. It's great to be back. I have been interviewed before, so thank you for having me once more.
Of course.
And I'm extremely excited because, as you mentioned, we're
the
going
upcoming
to
conference around the corner.
Yeah, we have this amazing upcoming conference which will take place on July 12th, which we'll discuss later. But
it's a Tuesday, right? Tuesday?
It's Tuesday, July 12th at the Diker Beach Golf Course in Brooklyn by the Verrazano Bridge.
Okay.
And I'm extremely excited about it. We have an amazing lineup, but in order to give you a little sample and for the radio show to kind of cover what's happening in the industry, I brought two dear friends and the best that the industry has to offer. And I'd love to pick their brain in terms of, what's happening and what we can expect.
Go ahead.
So,
all yours.
Should I turn it back to you, or
no,
should I
all
start?
Yours. Let's go through.
Okay, so I guess let's reach out to Morris. First of all, good evening and welcome to the program.
Good evening. Thank you for having me. It's an honor to be here with all of you, and I look forward to sharing some insight and learning from each of you here.
Thank you so much. So, first of all, I know your time and schedule is extremely packed, so I really appreciate you taking the opportunity to join us. So, I guess, can you give us a little bit of a state of the union with respect to the real estate space? We see some volatility in terms of interest rates rising and Meridian being one of the leaders, in the commercial space. I'd love to hear your overview before we go into some detail.
Sure. Just for the listening group out there, I'll give a quick overview on Meridian and who we are. Meridian has been in business for over 30 years. We're headquartered in New York City. We're the largest and most active commercial mortgage brokerage company in the United States. In addition to commercial mortgage brokerage services, we also provide investment sales services and retail leasing. So we cover the whole market. New York City is our home market, but we operate nationally. In the last 12 months, we've closed over $60 billion in financings, over 4,000 transactions. So we are number one in the country in terms of number of transactions, which means we're closing more loans than anyone else, which gives us a unique insight. With respect to, what we're seeing in the markets today, obviously there's been a very fast and rapid change in interest rates. And as many of your listeners probably know, valuations of real estate, returns in real estate are very much tied to the debt markets. On a given $10 million deal, a $10 million purchase rather, there's likely $7 million in mortgage financing on it. So the majority of the deal's returns are driven by the efficiency of the debt, which makes it so important. When the markets move quick, like they have, there's usually a bit of a period of workout, for lack of a better term, where lenders, borrowers, buyers, and sellers are all trying to figure out what's really happening and how to react to it. When it happens quickly, not everybody reacts as quickly. So what we're seeing in the market now is there's a big gap between borrowers and lenders and between buyers and sellers. Lenders, requiring certain returns, given their cost of capital has increased. Borrowers not necessarily willing to pay those higher interest rates and looking for alternative and creative solutions to work around it. And the same goes with buyers and sellers. Buyers looking to pay lower prices to generate higher returns commensurate with the higher cost of capital, and sellers not necessarily willing to drop their prices 5-10% or more just because interest rates changed over a 6-week period. So because some of these sellers have owned properties for 20 or 30 years, and they may want to hang on another 6 months and see what happens. So right now it's sort of the beginning periods of this quick and rapid change, and all of the market participants are really trying to figure out what it means in the short term, in the medium term, and the long term, and how they should react accordingly.
And do you forecast interest rates continuously rising because of inflation and trying to, catch up in the near future?
We don't provide interest rate forecasts at Meridian Capital. I'm curious what Shimon thinks. I have my own personal opinions. I believe that interest rates could very likely go up. And what's important for the viewers to understand is there's a big difference between the 5 and 10 year Treasury, which is a key driver, versus the Fed funds and SOFR rate. The Fed funds rate, which impacts the SOFR rate, is clearly going to rise further. The Fed has indicated that. How much further and for how long is going to be determined by the markets probably. The 10-year rate more likely reflects the market's overlook for the economy and interest rates over a much longer period than the Fed funds rate is. So I think there's a general sense in the market that rates can't sustain themselves at a high coupon for too long. But in the next 6, 12, 18 months, they're definitely going to go higher. But over a 5 to 10 year period, I think everyone thinks they'll stabilize, at more normal levels.
So now turning to you, Shimon. So you're the bank as well, and the bank itself. So the question is, where do you see the short-term concern or the short-term, real estate market? Are people holding back? Are prices dropping? Or people are just absorbing because it has been so low for so long, and now they're just they're still okay with it? What do you see happening in the real estate transaction space now?
So, similar to Morris, let me first begin by giving just a brief background on myself and Cross River. So, for those of you that have not heard of Cross River, we are a relatively small bank. We're just coming up on our 14th anniversary. We started out in the height of a different crisis in 2008. So I think what sets us apart probably from some of the other banks and lenders that are in the industry and in the space is that we actually learned how to adapt to challenges real time, on the fly, and again built the bank around these challenges. I don't like to look at them as challenges. I look at them as opportunities, and I think that the opportunities that have presented themselves to us really since the beginning have been, what has enabled us to get to where we are today as a bank, where, our humble beginnings with, approximately 10 million in capital to 10 billion in size today with, from 7 employees to almost 900 employees, including almost 200 internationally in Israel. For us, it's a matter of identifying the opportunity and maneuvering or pivoting to use the opportunity to advance and grow. And again, as I said, I think we've done that successfully over our short 14-year lifespan. And I think that this environment that we're in is a similar, while it has its own challenges, without a doubt, I think it will provide opportunity for us. And as I said, for those of you that don't know us, we're, many banks either immediately froze or shut down lending or just took a pause. We took that as an opportunity to jump into the market, offer assistance by leveraging our SBA platform, by leveraging our technology, and we were able to help thousands and thousands of businesses and hundreds of thousands of employees to retain their jobs by being the top lenders within the country. So again, I think it all points to opportunity and how we react to the time that we're in.
we're going to go to a short commercial break, but before I do, Shia, what is the website where people can go and get information and all the details about the upcoming JCon Real Estate Conference?
And thank you for asking. There you go. Yes, so once again on Tuesday, July 12th, running through the evening,
Okay.
we'll have this 6th or 7th annual real estate conference, which has been a sold-out, amazing event. Real estate
But it's
professionals.
not sold out yet. Yes.
That's right. And you can visit attendjcon.com. That's attendjcon, JCon.com. And you'll see a list of the speakers, the schedule, and you can get some tickets. And it always sells out prior to the event. So definitely a good idea to hop on the website now.
Amazing. Tonight's show is all about the future of the real estate industry as it looks right here from mid-2022. And we have very distinguished guests, Betesh, Senior Managing Director at Meridian Capital Group, and Shimon Eisikowicz, Chief Lending Officer and Executive Vice President at Cross River Bank, and joined by a good friend co-hosting with me here tonight, Shia Rubenstein, founder of JCon Conferences and the many other channels and initiatives that Shia spearheads. He's a tzaddik of a guy. Everyone here knows what a tzaddik is. He really is. Shia, thank you for joining me, and take it away.
Thank you so much again for letting me co-host
Absolutely.
Such a illustrious show. And thank you to my guests once again for being part of this. I do have to mention that with regard to the JCon Conference, because I come from a nonprofit space, we always want to put on a great event. We also try to bring and mentor people who came into the industry within the last 5 to 7 years. So they're seasoned, they're professional, but they're hungry. They're looking to grow. So by meshing 200 of the newer comers with 500 or so of the seasoned professionals, it gives it a good mix because those people are hungry, but they're successful. And of course, seasoned professionals love meeting with seasoned professionals as well as hungry people. And what's also beautiful about this event is that some of the amazing people, including Shimon to my right, have offered to take time during the networking portion of the event and have a table to be a mentor. So you know where there's red tape and it's hard to get through to people? You can just walk over to people that happen to be extremely successful in their space, whether it be construction, mortgage, real estate, multifamily, lending, and instead of that red tape, just walk over to them and get your 5 minutes.
That's special. Do they have to secure that in advance, or
no? So it's
just literally
you'll
walk
see,
up, tap the guy in the shoulder.
Yeah, there are about 15 different tables for 15 different specialties, and you walk up, and if the person's occupied, you either come back 5 minutes later, or you put your name down on a paper and you come back 5 minutes later.
That's special.
But before we continue, I do have to say, speaking to Shimon's point before, he mentioned about Cross River Bank, how they started and emerged from 2008 and made their way through one crisis after the next, and then, it was 2008, it was comeback season, it was Corona, and we're still perhaps even, trying to somewhat recover from the Corona aftermath. But I do have to tell you that starting from the beginning, wearing my nonprofit hat, because I also happen to be in the real estate and construction space, but wearing that nonprofit hat, I reached out to Cross River, and they've been consistently not only caring about the bottom dollar and not only caring, about how it affects them, but they even, when Corona started, they reached out to me and said, what does the community need? What can we do to help? And it's very interesting because they're perhaps, telling all their 900 employees stay home. They're thinking, how's lending? Yeah, how are we going to survive? How is lending and then they got involved in the PPP and they were killing it. And
one of the leaders in the entire country,
right?
If I'm not mistaken,
and they were killing it with the PPP, and so I was just amazed by their sense of caring for community, even when whatever they were doing was at stake. So I think that speaks volumes more than, every bank can do a loan or maybe doesn't do a loan, or the interest rate will be a little bit higher or lower, and of course it's about the people, because at the end of the day, you're going to roughly pay within the same frame of interest rate. You obviously want the best deal. But if you don't have that good person that can deal with your deal, and this really speaks to the true character. So I just wanted to put it out there. Yeah. And it happens to be that Meridian is no different because, I was speaking to Ralph before the Passover holiday season, and He was also extremely kind, helping so many people in need. So we've spoken, and he's also come through. And Meridian has also been a power force in the industry and on so many levels. So if I could take the opportunity to, personally acknowledge these two institutions who not only are good at what they do, but they're good people too. So thank you for that. Continuing on to our guests. So if I can just, ask you, so Morris, I guess shifting a little bit from general commercial real estate to construction, new developments, construction. Are the banks lending? Are they concerned? Are they not sure in terms of, short-term forecasting? Do they think the rates will impact condo sales or rental market? Can you speak to the construction space, and then I'll turn it over to Shimon?
Sure. So with respect to multifamily rentals, if we take New York City for an example, there's a great opportunity in New York City to develop multifamily rentals. The key component to making development economically feasible in New York was the 421A tax abatement, which as of June 15th has lapsed. And so beyond June 15th, at this point going forward, anyone acquiring land or planning to develop land is probably restricted from doing so without some sort of alternative incentive. So there really is going to be a lack of new housing developed, which will then put pressure on rents and continue to make these developments even more profitable than some might have believed. So I think there's a tremendous opportunity in multifamily housing. With respect to condos, we are hearing that there's a little bit of a slowdown in absorption of condos given the high interest rates. But at the end of the day, there's still tremendous demand, and a lot of inventory was taken offline with in the last 12 months, given the strength of the housing market. So frankly, at this point for banks, now is probably the best time to be making construction loans. You're going to be delivering these assets 2 to 3 years from now into a market that'll be substantially stronger at that point in time, with a lot less supply on hand, because it is definitely more expensive to build. It's more expensive to borrow. So there are going to be fewer projects delivered in 24 to 36 months, which is going to put pressure on pricing for renters and buyers and make those developments a lot more profitable and attractive. And from a lender's perspective, generally speaking, construction loans are floating rate. So the indexes are pretty high today. Spreads are 350 to 400, give or take, for construction loans. And in that space, you're talking about 3.5% or 4% above the SOFR index, which is projected to go to 2.25 at least by the end of next month. So you're talking about a 6.25 rate for construction loans. It's probably one of the best times ever to be making construction loans as a bank. Unfortunately, and I won't speak for Cross River, but many banks are backward looking and will probably miss this opportunity to make the best possible loans they could have made in the last couple of years. So now is probably the best time for banks to make those loans. It's our job to go out there and convince lenders of it and speak about the merits of our given projects and borrowers. But we might have a few less audiences to work with, but it's all about finding thoughtful lenders out there to make this happen. And I'm curious what Shimon has to say.
So what are your thoughts? A little jab came your way, but let's hear what your thoughts are.
Hold your thoughts on that response first. Josh, Shia, and Yitzchok, thank you very much for inviting me to be here this evening. And Shia, thank you for pointing to the charitable nature of Cross River, and I think that's important. I don't want to overlook that, because I believe and I know the rest of the organization believes that is a big part of our success. Our CEO Gilles, has a motto that he uses often, and I think it's something that we all use within the company: doing well by doing good. And I think that what you pointed to. Just in general, we strive and look for opportunities to give back and help many organizations at all levels, and I think that is a big part of our success. So thank you for the opportunity to participate and to volunteer my time to help with some of the attendees, and I look forward to trying to guide them or help them in any way I can. Morris, to your point, you were spot on in terms of, again, the opportunity here, whether it's construction or other types of loans. I know you know us. We do a fair amount of business with Meridian. You're a great partner. We always look for ways to work with you and your clients because at the end of the day, as you said early on, Meridian is a leader in the industry on the brokerage side, and for us, it's an opportunity to work with you and your clients and some of your staff. So I appreciate that. One of the things that we've said since, as I said before, since the day we were founded, really is, the rate market is the rate market, and there are banks that are just the lowest rate so that they can do the most volume. We were never built on having the lowest rate. We were built on opportunistic lending and really relationship driven. And obviously many banks use that relationship quote as a driver of business. But I think we've demonstrated that over the years that for us, of course, rate's important, but the relationship is more important. And I think that the environment that we're in and the opportunities that you discussed just now, whether it's construction or other bridge type of lending, or perhaps other interesting and opportunistic lending that exists today that maybe didn't exist as much or wasn't as prevalent, just a few months back. I think today it really goes back to that relationship which you pointed to, because at the end of the day, that relationship that we have with a good broker or with a good client, this is the environment and market for us to really demonstrate what that relationship really is worth. And for that, again, rate's important, but that's not as high on the list as I think you alluded to moments ago, as much as the bank's willingness to create a loan or structure a loan that makes sense for, again, that specific transaction. So I think the environment we're in is even more ripe for that to be the driving force behind behind many more transactions than may have been historically the case, especially with the low interest rate environment that we're just exiting.
Shia, before we go to a commercial break, what is the website where people can go to find out more information about the upcoming real estate JCon conference?
So once again, thank you, Yitzchok. And we will be hosting the JCon Real Estate Conference on Tuesday, July 12th at the Diker Beach Golf Course right under the Verrazano Bridge. Visit attendjcon.com. That's attendjcon.com for more information. See the speaker lineup, all the different presentations, networking, great food, mentors, anything that you can ask for if you're in the real estate space. Once again, attendjcon.com.
Mind your business with Yitzchok Saftlas right here on 710 WOR and throughout the world on the powerful iHeartRadio network. My guest this evening, Morris Betesh, Senior Managing Director at Meridian Capital Group, Shimon Eisikowicz, Chief Lending Officer and Executive Vice President at Cross River Bank, and I'm joined, co-hosted, with a good friend, Shia Rubenstein, founder of JCon Conferences. Let's go back to our incredible guest and find out the future of the real estate industry as it looks right now in mid-2022. Shia?
Thank you once again, Yitzchok, for having us on, and thank you, my guests, Shimon, Morris. Thank you once again for joining, for those who haven't joined until now. So I guess switching gears just a little bit, if we can stay within the real estate space, but switch that, since the rent laws have changed in New York State and there's been a mass exodus, or at least a mass diversion of investing in multifamily locally in New York City. I'm not saying people don't, but the people definitely started taking their money elsewhere. Can both of you or either one of you speak to acquisition out of state? I see on the multifamily side, but even more so on the commercial side. And again, both of you could speak to this. Tell us more about the trends of investing commercial or multifamily out of state and where you see this heading over the next 24 months. Morris, if I could start with you.
Sure. There's been a tremendous increase in New York-based investors investing in multifamily around the country. Some markets that were previously unknown to many local investors, they got educated on. Definitely in the Southeast, but even in the Midwest, and in West Coast and mountain markets as well. So investors really have been chasing yield outside of New York. The encumbrances put on the real estate market in New York City really made it very difficult to generate value-added returns. So people looked elsewhere, and we're seeing buyers buy product in the Atlanta suburbs, in the Carolinas, in Denver markets, in Indiana, anywhere they can get their hands on stuff. Right now, given what's going on with real estate, with interest rates, it's a very challenging environment because the cap rates on those assets dropped materially given all the increased demand and the historically low interest rates that we previously had. We've not yet seen those cap rates adjust. There are a lot of new players in the market, and I think this point ties to Shimon's comment before about relationships, as well as what we're seeing in construction financing markets. The next 12 to 24 months is going to be a bumpy ride for a lot of real estate investors, and the lenders and borrowers who are going to do well are going to be the ones that are the most well capitalized. So strong borrowers are going to be able to weather the storm, and they're going to be able to refinance their debt. They're going to be able to pay down their debt if they need to write a check of $1 million or $2 million to pay down a $30 million loan. So whatever the storm brings them, they'll be able to weather. There are a lot of new entrants to the market that were, syndicators, where they might have in a $5 million deal, they might have 20 investors who wrote them checks of $250,000 each. And when they have to come around and make a capital call to pay down a loan or to fund an interest reserve that got depleted or fund cost overruns, that's a lot more difficult. So I think you're going to see a divergence between well-capitalized buyers and investors and some of the newer entrants to the market who are less well-capitalized. And I think that's going to be the story over the next 12 months.
And how do you see also the New York real estate market? Because at the end of the day, multifamily is huge in New York City. So for the people that are in there and they're getting their tightened noose, how do you see them surviving between the upcoming 24 months and, people not paying rent for Corona and all that good stuff?
Well, the rent collections issues have mostly subsided. And I don't believe that is a ongoing issue at scale. But I think there's a dichotomy in the New York City rental market. The free market rentals, to my point earlier, are seeing higher rents than they've ever seen before. And that's because of a lack of supply. And counterintuitively, the rent laws have made housing more unaffordable in New York than previously. What they ultimately did was they prevented vacant units from becoming destabilized. There was never really a risk to tenants who were in occupancy. But for a landlord, once that tenant was out of occupancy, they had the ability to renovate the unit and charge a market rent after investing in it. Now that's no longer the case. So if you have an apartment that has been inhabited by a rent stabilized tenant for 40 or 50 years, and that tenant decides to move on, whether they pass away, they move out to the suburbs with their family, they have a change in their lifestyle, whatever the case may be, that unit now has a restricted rent. Nobody knows who to rent it to and how to rent it because it's unrenovated. And it doesn't make sense to renovate that unit. So a lot of that supply is being warehoused, and none of that supply is coming on the market for new tenants. So in a given year, there were thousands of units that turned over every year from rent stabilized to market rent, which were new supply to the fair market housing supply. Many people think about free market housing supply as only new construction, but that was not the case. You can take the neighborhood of Bed-Stuy, the neighborhood of Crown Heights, the neighborhood of Williamsburg, and there are thousands and thousands of units that were delivered to market through destabilization. Because that's not happening anymore, and it hasn't happened for the last 3 years, there's a tremendous, tremendous squeeze on supply. And that's why you're seeing lines around the block on Sunday for open houses for apartments for rent. So I think New York City probably has one of the best opportunities for free market rentals. And on the rent stabilized side, I unfortunately believe that is just going to be a long, drawn out process. And until things get really bad for both landlords and tenants, the government probably won't act.
Shimon, your thoughts?
A couple of things. So going, first question, then second question. So, to date, or, for the last, let's just say for the last 11 years or so, we focused on pretty much the New York, New Jersey, Connecticut market. We've selectively expanded that footprint with, again, relationship borrowers and really strong relationships to some out-of-state markets, similar to what Morris described. But Southern Florida, Maryland, Midwest specifically for some large clients and good relationships. But in general, our focus for the traditional CRE business is in the New York tri-state market. Where we've expanded to some of the, to pretty much all the states, is by partnering with some lenders, in those specific markets. So we provide either warehouse facilities for lenders that are active in that specific space, so they really understand the market. And, of course, they have some equity in those deals alongside us. So that gives us a comfort level. So this has been a pretty good market for us in those spaces. And similar to some other banks or other lenders, we've used this as an opportunity to partner with them and leverage their expertise in some of those markets where we may not have boots on the ground and have the real-time expertise required to extend good credit. So again, this has been a market of opportunity for us to leverage those relationships that we've built over the years and get into different markets where ordinarily we would not have the comfort or the staffing to be able to properly make the right credit decisions. But I still believe that New York at the end of the day is New York, and clearly we're going through some challenges, transition, and whether it's the rent laws, whether it's the abatements, or a host of other factors that are changing the landscape. At the end of the day, it's New York. The real estate is the real estate. And, as Morris said, the right sponsorship, the right equity in the deal should prove to be a sound credit at the end of the day, even if there are some bumps and, bumps along the way.
New York, New York.
She is a singer also, but
I just want to add one thing.
Sure.
Every couple of weeks, I have a dinner with some young analysts from Meridian, just to learn from them, hear about their thoughts, etc. So I had dinner with 4 analysts, all of whom are 1 to 2 years out of school. One went to school in Indiana University, grew up in Boca Raton, Florida. One grew up in Chicago. 2 of them grew up in Boston suburbs. And I asked them, did you guys think about moving anywhere else? You guys all grew up outside of New York City, and Boston's a big employment market. Chicago's a big employment market. Everybody says everyone's moving to Florida. And all of these guys came to New York City. And basically what they explained to me is they had no question in their mind where they were going. They went to school. They wanted to get into the real estate and finance industry. New York was the place to be. And all of their friends made the same choice. So New York City is still a city that attracts young employment talent. And that's what drives the real estate market, both on the office side and on the multifamily side. And I think it's going to continue to be a sustained quality market.
All right. Morris, how could people find out more about Meridian Capital Group?
www.meridiancapital.com.
Amazing. Thank you so much for joining us. I know you got to run. I'm going to stay on with Shia and Shimon. Again, Morris Betesh, Senior Managing Director at Meridian Capital Group. Thank you so much for joining us here on Mind Your Business.
Thanks, everyone.
Thanks, Morris. Nice seeing you.
Excellent.
Thank you.
Tonight's show is all about the future of the real estate industry as it appears now here in mid-2022. And our guest this evening, I'm co-hosted by Shia Rubenstein, founder of the JCon Conferences. There's a big real estate conference coming up in a couple of weeks. And Morris Betesh, Senior Managing Director at Meridian Capital Group, shared some incredible insights. And we're here in studio with Shimon Eisikowicz, Chief Lending Officer and Executive Vice President at Cross River Bank. Thank you so much for joining me here on Mind Your Business. Before we get to any last questions with Shimon, Shia, tell us about the upcoming conference.
Thank you once again. Wow, time
course.
flies when you're having fun.
It sure does.
Yeah, so it's great to be back, and thank you.
And when she is singing.
There you go. Thank you. I guess next time we'll push real estate to the side and we'll focus on song. But yeah, so it's very exciting. For the past several years, we've been hosting a JCon real estate conference. This year, it's going to take place on Tuesday, July 12th, at the Diker Beach Golf Course, right under the Verrazano Bridge. For more information and to get your tickets, because every year it did sell out in advance, visit attendjcon.com. Now, the beautiful setup about this event, it gives you the opportunity to work during the day if you're in the real estate space. And again, this is only for the people within the real estate industry. If you want to leave work a little bit early, you could come and golf. So you got that head start. You know, golf starts at about 2 o'clock. But the event itself starts close to 5 p.m. And, you know, it's a combination of several presentations covering the real estate space, whether it be acquisitions, multifamily, regulations. We even have Eric Ulrich, the commissioner of the building department, coming to address, you know, issues because, you know, a lot of us focus on acquisition or construction or returns. But what's with, you know, violations? What's with updated regulations? So it's very important to be able to know and forecast and address those issues because those really play into construction timelines, to financing, to costs. You know, if you don't take that into account, you can definitely, you know, have bumps in the road just for that itself. So, you know, we're going to be covering the obvious, you know, interest rates, where things are heading, multifamily acquisition, due diligence, and hear from a lot of professionals. We have about 20 different professionals in the space. And then, of course, after the presentations and after the keynote comes the fun time. You have networking, great food, bar, sushi on that beautiful outside 15,000 square foot deck. So that's beautiful. And yes, we do have a backup plan in case it rains. So we have tents in case it rains. But what I think is also unique about this event is it doesn't only cater to hundreds of seasoned professionals, but it also caters to people who entered into the industry within the last, 5 or 6 years. So they know the real estate space, they're successful, they're hungry, and not only do they come to hear that information, but they're also mingling with, 400 or 500 seasoned professionals. So it's that perfect mix. But to give them that leg up or that added value, we also have several mentors, about 10 mentors within specific industries within real estate. So if it's mortgages, acquisitions, multifamily, construction, development, you can just walk over to one of these tables and speak to that individual for 5 minutes, ask them your questions, try to make that connection. And, it's no red tape. So if you walk over to the table, if they're talking to someone, you put your name down, you come back 5 minutes later. But it's great that it gives you that access, and I think that was actually one of the best parts of last year's conference. Of course, we all like and expect, the good food and the golf and the presentations and to hear from professionals. But I think that was just another great added value. And so again, if you're in the real estate space and you'd like to join, it's going to take place once again on Tuesday, July 12th at the Diker Beach Golf Course under the Verrazano Bridge. And you can visit attendjcon.com for more information.
And any final questions and thoughts that we turn to Shimon Eisikowicz?
Yes, Shimon is a personal friend and is part of a fantastic institution, Cross River, which we discussed earlier today in terms of, their exponential growth, their gorgeous building in New Jersey, their 900 employees. Shimon and his team has been extremely aggressive on many fronts of the lending side. So I've been so happy to see them blossom. So it's as a friend and someone in the industry, I wear the other hat of being in the real estate space as well. So I can appreciate that. And I think all tonight's information was so invaluable. So I think if I can just ask my we pretty much covered most of the space in terms of multifamily and construction and forecasting, rents, out of state. But I think we didn't speak much about healthcare. I'm wondering if you have any thoughts on healthcare lending, whether it be assisted living, nursing home. Does Cross River offer any of those services? And do you have any thoughts on that? Because it's somewhat stable because people get sick, people need these facilities. But at the end of the day, there's always that real estate component. And how does that play out? And does Cross River deal with it at all?
Sure. So actually, healthcare, specifically nursing homes, skilled nursing facilities, assisted living, this is a space that we are active in. We have a team of 4 dedicated employees led by an industry veteran who's in the space for 25 plus years, Doug Esposito. So Doug runs the day-to-day in that space for us. It's been a very, very, good line of business for us. And like you said, it's certainly a good environment for it. However, like anything else, you need to be careful. And it goes back to what I said earlier. It's all about the relationship. It's all about knowing who you're lending to, who you're doing business with, what their experience is, what their expertise is. This isn't the time or the environment to be a cowboy and lend at just aggressive terms to borrowers. To Morris's point, that are just syndicators, if you would. So this is the time to really go back to our roots, and I think to all lenders' roots. It's the relationship. It's how well you know that client, and and their successes and even failures, and how they dealt with those failures. Failures are not necessarily a bad thing. It's how, and for us, that's what we look at. We look, going back again, as I said earlier, 2008, how did these borrowers deal with the banks when there were issues? And many people had issues, and it's just a matter of how they dealt with those issues. And as I said, there were many banks that themselves didn't deal with the issues properly by shutting their doors on their clients and not willing to talk to their clients or figure out a solution with their clients. For us, back in 2008, the height of COVID, no different. It's borrowers, there's unforeseen or unexpected challenges that arise. And a good bank with a good relationship figures out how to cure an issue and work with that client, as opposed to, again, shutting the door on that client. My experience, when a bank takes that approach, whether it's a construction project that's going sideways temporarily because of overruns or inflation or other challenges, or whether it's just vacancies or tenants that are not paying in a specific property, it's all about working with the client. And again, if the client has demonstrated their ability to come back to the table, discuss the issues that they're having, to us, those are the relationships we look for. Because not everything is perfect, and not everything, 2, 3, 4, 5 years after making a loan is the same as it was when you made that loan. So it's all about, it's easy to make that loan, as I said, at the cheapest rate and at the most dollars. There are many brokers and many banks that do that. And sometimes that works, sometimes it doesn't. It's the environment that we're in today that really will be, a test of those relationships and how the banks have hopefully learned, from the crisis of 2008.
I think that's so important because it's true. Like my mother would say, the only thing you do have is your reputation.
That's right. Because,
whenever you're at any juncture, you deal with a client, you do construction, you do that real estate, you deal with a bank, you could think short term, okay, they don't have enough leverage and times are bad. We have a crisis. We have a COVID. I'm out, or I'll tell them this. But the truth is, if you really invest in making that relationship work, people remember 10, 20 years later.
Absolutely. Shimon, before I let you go, how can people find out more about Cross River?
Go to our website. crossriverbank.com.
Easy enough. Shia, before I let you go, we're out of time. What's the website to find out more information about the amazing upcoming conference?
The amazing upcoming JCon Real Estate Conference will take place on Tuesday, July 12th at the Diker Beach Golf Course under the Verrazano Bridge, and visit attendjcon.com.
What an incredible show. Morris Betesh, Senior Managing Director at Meridian Capital Group, Shimon Eisikowicz, Chief Lending Officer and Executive Vice President at Cross River Bank. And of course, I was joined by Shia Rubenstein, founder of JCon Conferences, and so much else. We're out of time. Tune in again next Sunday night for another great edition of Mind Your Business right here on 710 WOR. Have a successful week. Thank you for watching, and make sure to subscribe to this channel and be notified every single time a new video goes live. Don't miss out on any of the weekly interviews that I have with top business leaders, sometimes Fortune 500 executives. Hit subscribe and turn on notifications.